Warren Buffett knows what he's talking about.
Don't you mean Warren Buffett?
What's up, everybody? Welcome to the Richuation Room. A little bit of a different setup for today's episode. No guest. I'm actually going to be going through a recent white paper that was produced by ARK Invest. And for those of you out there that aren't familiar with ARK Invest, they've caught a lot of traction recently, although they've been in service now for about 4 or 5 years. But they're an investment firm focusing on disruptive innovation, offering investors solutions seeking long-term growth in the public markets. They have, I believe it's 5 ETFs. And the big thing here is that they focus on disruptive technology and disruptive things that they think are going to impact kind of the traditional industries, which we're going to get into a little bit today. Their CEO and CIO is Cathie Wood. She's famous for having a very bullish stance on Tesla. I think their maximum bull case pre-split was $12,000 a share, and I think their standard bull case was about $4,000 a share. Again, this was pre-split. At the time, they kind of looked crazy a few years ago for making these claims, but people have been paying a lot more attention, obviously, since Tesla's had its run-up in the past few months. They focus on 6 main subject areas: artificial intelligence, autonomous vehicles, fintech, DNA sequencing, robotics, and 3D printing. And just like most firms, they frequently put out white papers, which are basically in-depth research about different companies, different ideas. And in this case, we're going to go over what they call the Bad Ideas Report 2020. So it's going to be 5 industries that they think are due for a lot of disruption going forward, and they think could be impacted greatly by new technology that's kind of springing up. So we're going to jump right into this. I'm going to share my screen and we will go through the report itself. I'll have this linked below, so I encourage that you guys kind of go through and read it yourself. And just so you know, that most of this is not my personal opinions. I'm really just kind of giving a quick summary of this, so you guys don't have to necessarily go into the weeds as much as I did. But I'll give kind of my 2 cents on a lot of it. But for the most part, I'm really just kind of going over what the ARK research team produced on October 14th. So first thing for their Bad Ideas Report, we're going to go over the actual industries they think could be bad ideas going forward. So we have physical bank branches, brick and mortar retail, linear TV, freight rail, and traditional transportation. So jumping into the first one, we have physical bank branches, and I'm going to take it down to one of the charts here. Overall, internet and technology are changing the way that money is distributed and the distribution of financial services, and they're doing so in a way that's much more cost effective than what you can expect from your typical bank. So finance and insurance accounts for about 8% of the GDP in the United States, and new digital wallets, digital alternatives, things like Cash App and Venmo and smaller ones like Chime have really started to take over a lot of the market share for a slew of different reasons. If you take a look at this chart, it's going to have number of users in millions on the left in comparison with time on the bottom starting in Q2 of 2016. Very obvious with Wells Fargo being the red line, pretty stagnant at just under 25 million users. Really hasn't changed there, where things like Cash App and Venmo have clearly had an exponential growth to the right, starting at almost 0 and now kind of capping out right now anyway at about between 30 and 40 million. So a ton of growth there. And the question is, why is this happening? Well, traditional banks, they spend a lot of money to acquire each customer. So you think about seeing a Chase Bank or a Wells Fargo commercial on television, all that costs for advertising, it ends up being about $1,000 per customer just to kind of get them working or using that bank of preference, where these smaller or more versatile and digital assets like Cash App and Venmo, it comes out to be about $20 per person to acquire. So that's about a 95% decrease in the cost of money that they're spending just to kind of get more customers using their product. A lot of other things we can talk about here. One, ease of use. I kind of compare it to have the Robinhood versus Fidelity or Robinhood versus Vanguard conversation. A lot easier to invest on Robinhood. I think it's a similar thing here. A lot easier to send your buddy money for beer or money as maybe it's your roommate or something via things like Cash App and Venmo, where there aren't all these barriers in between with differing banks than you're going to have with these more traditional banking services. Not to mention, a lot of these banks have tried to produce digital assets where you can send and receive money. But again, if you don't have the same bank or they're not using the same service like Zelle or something like that, then you could run into a lot of issues there. The other thing that these banks have is they are obviously working typically brick and mortar branches. Obviously, if you have a physical store location, you're going to have a lot more issues there. You have to pay for insurance, you have to pay for potentially rent on the land, and then all the other things that come with actually owning brick and mortar, where things like Venmo and Cash App, which are owned by PayPal and Square, can be a lot more versatile, a lot more fluid, and can change more with the times because they're not locked down to all those certain locations. So the first one being physical bank branches is going to be the first one that they're saying is due for a lot of disruption going forward. Second one we're talking about here is brick and mortar retail. So you think about Macy's, JCPenney, Sports Authority, whatever else you want to kind of cap into that. But with the recent pandemic and with COVID, it was already, e-commerce was already taking over, but now it's just kind of exponentially gotten into a much bigger phase where the US e-commerce basically went from 11.3% of sales at the end of last year, 2019, all the way up to 16.1% of sales in quarter two of 2020. So that's the largest jump in history that they've seen. And obviously a lot of that is predicted or has been thrown forward by the pandemic that we saw. ARK Invest actually also predicts that drone usage will be used to deliver packages in the very near future. And they think that they can essentially make that happen for about 25 cents a trip, which is crazy, and expects the global e-commerce to account for 60% of retail by 2030. So if we take a look at this figure here, let's see, is that figure 4? Yes. So we look at kind of as non-e-commerce retail is going to be the darker color, and e-commerce will be in the light purple. As it continues to jump forward, 2010 and 2015, very small portion. 2019, you're going to see that lighter purple is getting bigger, and then their prediction by 2025 is that about 60% of all retail will be done online. One of the quotes down here that I think is interesting, I'll just read straight from the page here, if I can find it, is while some companies will transition successfully to an e-commerce model, ARK expects more bankruptcies during the next 5 to 10 years, as not every business will survive or cut retail assets quickly enough. In the fixed income markets, the performance of REITs with high exposure to retail real estate will continue to be at risk as their underlying assets become less valuable and will have to be repurposed. In ARK's view, the decline in retail real estate values during the pandemic is a preview of what's to come. So I think that's kind of saying a lot there, and they're kind of calling out REITs also, the ones that at least deal with a lot of commercial and retail type real estate, that they got to kind of look out because everything's trending more and more to e-commerce. And another thing that I think is interesting here is that the pandemic has almost caused people who maybe were not comfortable buying things online to have to do so because they're not able to leave their house. And once you get used to it and you realize how easy it is, I think you're kind of hooked. So I don't know anyone really that realizes how easy it is to buy stuff online that is then going to go back to doing things the other way. Obviously, you'll have a few. I don't think malls are necessarily going anywhere right away, but definitely kind of an interesting space that will be seeing a lot of disruption going forward. Number 3 is linear TV. I was kind of curious what linear TV even meant, kind of inferenced, but basically linear TV is real-time programming via cable and satellite at scheduled time. So just think about either standard cable or dish TV, all that kind of stuff. And then what they're going to talk about here is, they're going to talk about things like cord cutting. Most people are familiar with that, but that's just basically getting rid of cable in favor of using internet services or different streaming services. Think Netflix, Disney Plus, Hulu. Places like that. Similar to what we talked about with retail, the pandemic has definitely accelerated this growth in terms of getting rid of linear TV for multiple reasons. It's a lot cheaper just to go with internet services and streaming services. And also people are looking for more entertainment. They're not able to leave the house and go to the movie theater, not able to leave the house and go bowling. So they're going to be more willing to pick up additional streaming services and save themselves money by getting rid of cable. Let's go down to figure 8. So figure 8 is showing how much cheaper it is for Netflix to provide content for its users. And this really isn't even including advertisements. So you have dark purple showing cost per hour of cable TV. Again, no ads. And light purple showing cost per hour of Netflix. And you can see, it's maybe 1/4 of what it costs for cable TV. Again, similar to what we talked about with Cash App and PayPal, allowing these streaming services to be a lot more fluid, obviously bring in more money, and allows them to make adjustments if they need to as the world continues to change. All right, number 4 is freight rail. I thought this was an interesting one. I don't personally, it's not something I really think about too much, but ARK obviously believes that it's going to be due for a lot of disruption going forward. And a lot of this is based off of their firm belief in autonomous electric trucks, basically kind of coming in and taking over what a lot of the freight rail typically does. They basically think that these autonomous trucks could undercut rail prices more than $400 billion, or could undercut the prices, and more than $400 billion in fixed assets will be at risk. In the next 5 to 10 years, ARK expects electric trucks to reduce the cost of trucking from 12 cents per ton mile to 3 cents. So again, massive decrease in costs there. And then if you just think about the ability for a truck to go door to door, it's a lot less, you cut out a lot of the middlemen. So in order to get things on a freight, you typically would have to probably truck it there or barge it there, get it onto the train, take it to its location, then again, get the goods off of the train onto another truck, and then take it to its final destination. Where if you have autonomous electric trucks, you can load the goods on itself, and then it could pretty much show up at the door of where it needs to go, or then where it needs to be distributed if it's something like, an Amazon shipment or whatever the case is there. Figure 12 here is showing the cost per ton mile by mode. So really the only thing beating out an autonomous EV truck is a barge. So rail, about 1 cent more. Human-driven diesel truck, about 9 cents more? Then obviously sending anything via the airplane is going to be a lot more expensive for obvious reasons there. And public rail accounts for about 12.5% of the S&P 500, which was pretty big in my opinion. I don't really think about this too much, so that was pretty surprising. And it's worth about $760 billion in U.S. public equity enterprise value. And a lot of this weighs on if we can get to a place where autonomous electric vehicles are not only being used by the masses, but also being accepted legally into being used. And then these trucking companies and, making that switch over, or at least the car companies putting out kind of their own distribution network. So a lot needs to go on here. I don't know if I necessarily believe that this is going to happen as quickly as ARK thinks it will, because there's just a lot of steps and a lot of hoops that need to be jumped through to get there. But in the maybe a little bit further out than they're expecting, maybe another 5-10 years out from what they're expecting, I could see some of this starting to take place on a personal note. The last one we're going to talk about here is traditional transportation. Again, this focuses a lot on some upgrades in terms of the vehicle market. So Robo Taxis is kind of what the big focus is on here. And they think that Robo Taxis could reduce the cost of point-to-point mobility in a huge way. Basically could become the dominant form of urban transit. So you're probably not going to see this in the very rural areas where there's long stretches of road between small towns. But you think about the more condensed populated areas, they think that robo taxis will be taking over in a big way. So in terms of US auto sales per year, they think that it's going to drop from about 17 million units, which is roughly what's going on today, to about 10 million units by the end of the decade. And a big reason for that is people just not needing as many cars if robo taxis are available at the click of a button. Not only that, but they think that basically US auto sales will fall 50% in the next 2 years. So again, cutting it down even more. And then they think that robo taxis will not only impact the people that have cars living in the city, but also potentially impact some of the air travel market for shorter term trips. So if you think about if you're taking a 2-hour flight somewhere and you live 45 minutes from the airport, where you're going to drive 45 minutes to the airport, you're going to spend probably another 45 minutes in the airport, assuming that the lines at TSA aren't too busy. You're going to get on your flight. That's 2 hours, call it about 4 hours at this point, another 30 minutes to get your bags, and then we'll call it 30 minutes to get to the next spot. Now you're looking at about a 6-hour trip, when if it's 2 hours away and you can order an autonomous taxi, you don't need to pay any attention to the road. Hopefully you don't. And you can just kind of hang out on your iPad, do some work, enjoy some entertainment, and be there in 2 hours. It's a pretty easy choice there in terms of what you're going to do if the cost is going to be a lot lower, which it looks like that will be the case as well. The other thing that to start thinking about here is the traditional ride hailing services. So things like Uber and Lyft are also going to have an issue with this. So they'll either need to basically partner up with the companies that are supplying these autonomous robo taxis, or they might find themselves pretty much getting pushed out by that kind of competition. And then they're going to have to drop their costs big time in terms of how much they're paying their drivers on a take-home rate, or really not paying their drivers, but how much they're taking home based off of after the driver does their thing and their driver gets paid out. So they will see their profit margins shrink big time if autonomous EVs can hit the road by these companies, not even needing to be manned by drivers at any point. Another thing to think about here with autonomous taxis is how it's going to impact the rest of the automobile market. So you think about people buying less cars, there's going to be less need for car dealerships, there's going to be less need for a lot of car maintenance. So a lot of these things are going to get trimmed down, and you're going to see it get a little bit slimmer and slimmer. And it'll be an interesting thing to watch kind of going forward. If we take a look at figure 20 here, figure 20 is talking about the enterprise value at risk to robo-taxi disruptions. So it's about $7.7 billion of enterprise. And then the one thing we didn't even get into, which is probably the biggest one of all, is how oil and gas will be affected. Obviously, oil and gas is a huge part of the ICE vehicle market right now. And with more and more electric vehicles, taking over the market share, as you can see in the purple there, about $4.1 billion worth of oil and gas enterprise could potentially be disrupted. Green portion, you have auto manufacturers, auto and truck dealers, rental. That's weird. I guess rental is what they're looking for. Rental and leasing services in green. In the gray, you have insurance and property casualty, airlines like we talked about, and then a very small portion of software applications up there as well. So the last one here that they think is going to be really impacted is the traditional transportation. And I think we all kind of see that coming based off of what it looks like companies like Tesla are trying to do to disrupt basically that industry and allow people not only to buy Teslas, but then to be able to essentially rent their Teslas out autonomously to go pick people up and take people to different locations, while they're hanging out at home and make themselves a little bit more money. So it's definitely an interesting time there. So kind of to wrap this up, the way I kind of finish this is I think about, as being an investor myself, what are the things that we can do to get ahead of the trends here? And I'm by no means giving financial advice. Do your own research, do your own due diligence, take a look at what ARK wrote. Whether you agree with them, whether you disagree with them, that's going to be up for you. Maybe you agree with one or two of their points, but not all five. But the point is, ways that we can capitalize on this is, one, to continue to stay engaged in the market, continue to keep an ear to the ground so you have an idea of what's going on and what the changes are and how things will be disrupted in the future. And then try and find companies that you think, publicly traded companies for most of us, that you think will be, being able to get the lion's share of each market. So I'm just kind of going with a few of them off the top of my head based off of things we talked about. But e-commerce is an obvious one. Shopify, Amazon are probably the two big dogs in that. Traditional transportation, think Tesla, think other electric vehicle companies that are going autonomous. The major bank branches, you think Square, PayPal. I'm trying to think about the other ones off the top of my head, but I think you kind of get the point. So take a look at what ARK talked about. A lot of this is on their website, and they have a lot of good details on there that kind of go into the specifics for each one. But that's kind of what I think about as an investor. And I'm personally invested in some of the ARK ETFs just because I'm a huge fan of their work, and their track record, at least right now, speaks for itself. So we'll see how they do in the future. I always like to keep a close eye on what ARK is doing because I think they are definitely innovators, and they are seeing into the future a little bit more than a lot of the traditional investors and traditional firms. So I hope you guys enjoyed a very quick breakdown of that. Things to think about going forward as this world is ever changing, and we'll see you in the next one.